Hey everybody, welcome back to another edition of 5 Question Friday. As always, you've sent in some great questions. We're going to tackle 5 of them in this short video. If you want to submit a question, just subscribe to the newsletter. You'll get a link, see a link to that below the video. It's free, it goes out every Sunday morning. And you can just hit reply, send me a question. I do my best to keep up with them. I can't reply to every email, but I am replying to as many as I can. But even if I don't reply, I have read it and I add them to the list for 5 Question Friday. So with that, let's dive right in. Here are the 5 questions. Should your retirement plans change if right before you're going to retire, there's a big market crash? And you'll see the question, but it's specifically related to the 4% rule. How do bond ETFs generate returns? That's a question, so that's a good one. Are Timothy funds a good option? I'd never heard of them before I got this email. Timothy funds are a Christian-based mutual fund company, I guess, is the best way to describe them. 4 is Fidelity HSA, health savings account, a solid account, a good option. Also had an HSA question we'll look at. And then, looks like I can't type. Here we go. Should Schwab, or they have a robo-advisor, they call it Intelligent Portfolio. How do we think about that as an option versus maybe just a target date retirement fund? So that's what we're going to dive into. And so here, let's get right to it. The first one, should your retirement plans change if the market crashes? This is a fun question. It's really the boldface part of the email. What if I was about to retire in 6 months and I'd planned a $100,000 annual withdrawal based off of 3% of my savings? So in other words, they're going to take out $100,000 a year, and that just happens to equal 3% of their total retirement savings. So if you think about it in the context of the 4% rule, that would be pretty safe, right? But then they say, what if, within that 6-month period, I'm ready to pull the trigger and retire. There's a significant drop in the market. What do I do? Do I have to change my plans? And here's the interesting, I think, question that this viewer is getting at. Let's imagine we retire before the market crash, and we take out our $100,000, and that's only 3% of our savings, so we're doing great. And the market crashes, and let's just say our portfolio falls by 50%. And so what that means is when we take out our next year's withdrawal, remember we're going to throw away the percentages. We only use 1% for the first year if we're following something like the 4% rule. And so what we're now going to do is take the $100,000 and adjust it for inflation. Let's say inflation's 3%, so in year 2 we take out $103,000. But because the market has dropped, let's imagine that $103,000, let's say it's a big drop, 50% or something crazy, right? But it could happen. So now you're taking out like 6%. But if you're following the 4% rule, that's exactly what you do. You ignore the percentages. You ignore what the market's doing. You even ignore inflation. I mean, you use it to adjust your spending, but a strict adherence to the 4% rule, as Bill Bengen envisioned it in his 1994 paper, you would ignore all of that. It's easier said than done, right? And you'd take out your $103,000. On the other hand, let's imagine you have neighbors, and they just decided to wait a little bit. They didn't retire right when you did. They retired a month later. And it was after the market crash, after their portfolio. Let's assume you have the same amount of money, and their $1 million or whatever it was dropped by 50%, and they go to retire. Now they have to calculate the 4% based on this new lower balance. And so in the first case, when you retire a month before the market crash, when the market crash happens, it has absolutely no effect on what you're supposed to do if you're following the 4% rule, right? You keep on going, you keep on trucking. But for someone that waited and retired just shortly after the market crash, it has a huge impact on their retirement. If you're following the 4% rule, because you're going to apply that 4%, to your new much lower balance, which would mean you couldn't take out $100,000. Even if it was 3% before the market crash, let's assume you lost 50%. So after the market crash, $100,000 would be 6%. Well, that doesn't work, at least if you're following the 4% rule. So you have to take a big haircut, right? You have to take a big pay decrease and only take out 4%. And there's part of that it just kind of feels artificial, right? This doesn't seem right, but that's a strict adherence to the 4% rule. So what's my take on that? There's the saying when it comes to economic models that all of them are wrong, some of them are useful. And I kind of view that way with rules of thumb when it comes to investing and retirement, even the 4% rule. I think the 4% rule is wrong in the sense that I don't think it's a very good rule to strictly follow to actually plan your retirement. But I do think it's useful. I think it's useful from a planning perspective. It can also sort of be useful from you're in the middle of retirement, you're taking out your money that year, however you calculate that amount. I think it's useful to say, hey, what percentage of my portfolio is this? Now, that doesn't mean that 4% is always the benchmark, right? When you're 92, 4% probably doesn't matter as much because your life expectancy is a lot shorter. But I still think you can use different rules of thumb as sort of just a sanity check. So one of them that I like a lot is simply the RMD calculation applied to all of your accounts, not just your traditional 401ks and IRAs, just to get a sanity check. Am I spending, roughly that amount? If I'm spending 5 times that amount, that might be a problem, right? And so you can use these as sanity checks. But what I personally prefer is to use retirement planning software like Boldin or Projection Lab, and use that to really think through, do I have a sound retirement plan, not a sort of strict adherence to the 4% rule regardless of what's going on in the market and regardless of what's going on with inflation, because I just don't think that's reality. It's certainly not my reality. Maybe it's yours, but it's not mine. So the viewer's question really does underscore an aspect of the 4% rule that's really kind of artificial. And so, again, I think it can be a reasonable starting point for planning and thinking about these issues, but I probably wouldn't stop there. I would go beyond that. That doesn't mean I'd take out the $100,000 after a 50% market decline, by the way. That's a pretty difficult market to live through. I suppose the upside to that is that our expected returns going forward after that 50% drop are higher than before the 50% drop, but probably not a lot of comfort. So that's my take. I wouldn't adhere strictly to the 4% rule. I'd go beyond that and probably use some software like Boldin or Projection Lab to get a more refined sense as to how reasonable my retirement plan is. But great question. All right. Number 2, how do bonds generate returns? So Tim said, I'm confused as to how bond ETFs, I think this might apply to mutual funds as well, are priced and where the return on investment comes from. Does one make a profit off the increase in share price, or does the fund deposit interest payments into my account in a similar way to how stock ETFs deposit dividends? So it's a little bit of both, actually. And we can see this in action. So I just looked up BND. This is a fund we look at a lot. We could have put any bond fund in here, but this is a Vanguard Total Bond Market ETF. And it invests in U.S. government bonds, treasuries. It invests in high-grade, investment-grade corporate bonds, some mortgage-backed securities. And I've gone to the Performance tab. This is in Morningstar. And when you go to the Performance tab, you actually see this first. So it just shows you its returns. You can look at it by year and then over different periods. And then if you go to the Distribution tab here, it will show you its distribution. So the green is income. So in a stock ETF, that income would be principally, I guess, maybe entirely dividends. This is a bond fund, so it'd be interest, right? And this is year 2021 through 2025. So 2025 obviously is still ongoing. There'll be additional interest payments, and you can see it's a monthly. You get interest payments monthly. They may not pay any in January. They didn't in 2025, but they made 2 payments in 2024. I don't know if that's how they do it every year or not. It may be. But you basically get interest payments of some amount every month. Now, what about if the prices go up and capital gains? Of course, they're trying to, I think like most Vanguard index funds, keep actual capital gains to a minimum. This is in terms of distributions to you and I. So you can see short-term and long-term would be in blue. Looks like they've only had long-term in the past 5 years, and they were both limited to 21 and 22 and relatively small amounts. Now, so that's what the fund distributes to you. Now, if you went and sold shares of the fund, you could be selling at a gain or loss, depending on, of course, what you paid for it when you bought the fund, and what you sold it at. A lot of that will be determined based on how interest rates have changed over time. So again, there could be, for you or me, more capital gains or capital losses potentially based on when we sell. But assuming we don't sell at all, we're just talking about what the fund does. This is a great picture. This shows you what the fund itself does, and it's primarily interest, right? They're gonna want to try to limit as much as possible the capital gains that they sort of force on us because it's taxable, right? If we have capital gains because we sell, well, that's fine. That's on us, right? But they're trying to limit that as best they can. So another great question. So appreciate that, Tim. Speaking of Tim, how about Timothy funds? This came from Leo. I would appreciate if you could take a look at these funds. I guess he heard about them on the Dave Ramsey show. He recommended these mutual funds to a listener. Boy, that angers me. I got to be honest with you. So here's the Timothy funds. I can't believe Dave Ramsey recommended these. I really can't. But again, as I said before I got the email, never heard of them. The idea behind them is these are sort of funds that invest in a way that would be consistent with the Christian faith. I don't talk a lot about religion, but I come from the Christian faith. My wife and I go to church, so I don't have any objection in theory to someone. And by the way, this would be true regardless of your religion, or maybe your investments are more focused on social issues. I got no issues with that. I don't invest that way. I don't invest based on some religious beliefs or social beliefs. It's just not my approach, but I certainly understand why some people would. I've got no issue with that. The issue I have with this, and I looked at several of these, and I think it's probably going to be true for all of them. We'll look at their large mid-cap growth. And you can see the first thing I saw, when I saw this, I thought, uh-oh, we're in trouble. That's an A share. That means there's sales charges, load charge. I think it's 5.5%. So in other words, you invest $100,000, $5,500 come right out, right off the top in fees. Now they have C shares, C class shares, which don't have that load, which you can buy. The I think, is probably for institutional. But the problem, and it's true whether you buy A or C. If you come down here, where is it? Here we go. The net expense ratio on A shares, and by the way, this is after you've paid a sales load, is 1.35%. If you don't want to pay the sales load charge on the C shares, it's 2.1%. I don't need to look any further. I honestly don't know how a Christian organization does that, and it feels good about it. I really don't, and I have no earthly idea in what world Dave Ramsey, and I didn't hear this, I'm just basing it on what the viewer told me, but I don't know in what possible world Dave Ramsey could think this is a good investment. I'm getting angry just thinking about it, so I'm going to move on to the next question. There you go. That's my take on that. Was an easy one. Okay, HSAs. So really there were two questions, sort of like, what do I think about the Fidelity HSA? My wife and I do have Fidelity HSAs. And then down here, this was from Richard. He had a question that he didn't understand. He heard me mention that I save medical receipts that I can use to withdraw funds from an HSA down the road. So those are two questions. Let me start with the second one about how HSAs work. So with flexible spending accounts, you got to spend it all or you lose it. And I remember years ago trying to think of, how much should we set aside? I'm scared to death we're not going to use it all. And then you had the carryover. You could use it until, March or something. Well, with HSAs, you don't have that problem. There is no use it or lose it. You can keep money in an HSA for decades. And so here's the deal. If you have a medical expense that's not reimbursed from your insurance, you have to pay out of pocket. So, you go to the doctor, it's $100 or whatever. You can save that receipt. And at any time you want, pull the $100 out of the HSA tax-free. And if the IRS ever audited you, you'd say, I got my receipt right here. And it's got to be an eligible medical expense, but you got to have your records. But you can do that. So you can do it 20 years later. You don't have to do it the same year you actually spent the money. And so what we do is I want to keep the money in the HSA because I want to keep it growing and compounding. It's tax-free. And I save receipts. And so what I do is I save the receipts in a file, and I have a spreadsheet that links each row, has the date, the provider's name, the doctor, or if it's it's a lab, or you get an MRI on your shoulder that's killing you, like mine is. Where that was, the amount, and then I have a row of or column of check boxes, where if I actually reimburse myself from my HSA for one of these expenses, I can just check the box there, and I know that I've already used that one. I haven't used any of them yet. We just keep accumulating them, and so we have this, a nice size amount of medical receipts that we could use to pull money out of the HSA tax-free anytime we want. I don't know when we're going to use it. I think we'll probably start using our HSAs around the time we start taking Medicare, but we'll see. By the way, the tax code or law that's pending in front of, I guess it's now at the Senate, has some big changes to HSAs potentially. So a positive if you're someone that saves in an HSA, including the ability to use it for parts of Medicare. I think Part A that you can't now, and some other things. But anyway, so that's question one. As for Fidelity, I love the Fidelity HSA. Why? Why do I think it's so great? Well, here it is. No account fees, no commissions. You can basically invest in whatever you want. And this is important. You can invest 100% of the money you put in the account. And you may think, well, Rob, that doesn't seem that, why couldn't you? It turns out that some HSAs require you to hold a certain amount of your HSA money in cash before you can then invest the rest. And so there's a phrase, I think it's something like first dollar investing, that you might hear from some HSAs where they say, hey, you can start investing your first dollar. But a lot of HSAs, they say, no, you've got to keep some amount in cash. And frankly, it's just their way of making a little bit of money off your cash. So I don't like that. And the HSAs that I had through my employer, all of them required that, which really annoyed me. But in any event, Fidelity doesn't require that. You can invest 100% of it. I think it's great. So I like it. All right. Are we through 4? Did I skip one? Have I done? We're already to question 5? Let me check off some of these. Makes it feel like I'm making progress. Okay, question 5 from Charles. He and his wife, they're retired. They're in their 60s. His question is, and part of it is that she is not into managing their investments. Okay, I get that. I got a wife like that. So his question is, will she be better off in terms of just managing all of this, keeping her IRAs in a Schwab robo-advisor, which I guess is currently at a 70-30 allocation, but maybe they'd shift to 50-50, or target date fund, and they mentioned, Charles mentioned a 2035 fund, maybe from Vanguard or Schwab. So I think both of these are reasonable options. That both of them make managing the assets pretty easy, right? I mean, you don't have to do much, but I think there are some pros and cons. Let me start with the target date fund. The issue here, and first of all, I doubt that a 2035 fund is a 50-50 allocation. I can't imagine that it would be. Maybe it's close. Maybe it is. But even if it is, it's going to change over time. So if you wanted to maintain a 50-50 allocation, you would have to be, not frequently, maybe every 5 years or so, if you're okay being a little off the 50-50 mark, taking the money out and putting it into, in 5 years, you might have to put it into what would then be the 2040 fund, right? If it's in a retirement account and there's no tax issues, which is probably where you'd want to keep this anyway, maybe not that big of a deal. But there is some management of that, because remember, with target date funds, the allocation changes. Now, you could use something like a Vanguard Life Strategy Fund, but I don't believe they have a 50-50 option. It might be 60-40 or 40-60. The benefit there, though, is the asset allocation doesn't change. They maintain that allocation. So that's how I think about target date funds. We use one in our retirement account, but I use the one that's sort of at the end of the line, the retirement income version, which I think is around 30% stocks and 70% bonds, and it works out for us for our overall allocation, and it shouldn't be changing. So anyway, that's with target date. What do I think about Schwab? So Schwab's robo-advisor is not my favorite. I don't think it's unreasonable. I much prefer Betterment or Wealthfront, but why? So let's see here. Here's their website on their intelligent portfolios. One of the things, so it's free in the sense that there's no management fee, right? So Betterment and Wealthfront are basically 25 basis points. It's 0.25% plus the cost of the underlying index ETFs, which are very cheap. I think Betterment has a 40 basis point option if you want a certified financial professional, but basically 25 basis points. Schwab's is free. I'll do that in air quotes. It's free. What's the issue? You're forced to keep a certain amount in cash. So the least amount of cash you can have is 6%. That's if you pick the aggressive. But Richard wouldn't do that. Did I get the name right? Or is it Charles? Charles, sorry. Charles wouldn't do that, right? Because that's 94% stocks. They want something that's closer to 50-50. Let's see moderate. Okay, so moderate is 50-50, but of the fixed income, only 38% are in bonds and 12% is in cash. So problem number one, you might not want 12% in cash. The second thing is, this is how Schwab makes up for its quote-unquote free robo-advisor. They're making money on your cash. That's why they're doing this. And it got them into trouble. Let's see here. This was from 22. Charles Schwab to pay $187 million to settle SEC charges that it misled robo-advisor clients on fees. Yeah, the agency alleged Schwab didn't disclose a cash drag on client portfolios, which enriched the firm but caused investors to make less money for the same amount of risk in most conditions. Schwab neither admitted nor denied the claims, which is pretty standard. So that doesn't give me a warm, fuzzy feeling, and I don't like my portfolio being dictated because of the way the provider wants to make money. The other thing I don't like about it is it's opaque. It's opaque. It's hard to know what this is really going to cost you. If they just said, hey, we're going to charge 25 basis points, well, then you know, and you can calculate and you can decide what you want to do. So now you're going to have to say, well, what does this cash pay? I found this resource from Schwab. Looks like as of just earlier this month, it's paying $3.95. I guess it tracks the Schwab government money fund. It's not horrible for cash, but who says you want 12%? I mean, 12% in cash? Well, I don't want 12% in cash. The real drag is going to be the $3.95 you get on this versus what you would get if you could invest it the way you want to, right? So is it the end of the world? Is this some horror show that I would say, oh my goodness, avoid Schwab's robo-advisor? No. But is it my favorite place to put money? No. And if I personally had to choose between this and a Vanguard target date retirement fund that worked, I would definitely go with the target date retirement fund. Yeah, that's my take on it. So that's it. I will leave some links below the video. I think, is there anything worth linking to? You can probably find all of this on your own. I don't need to link to it. But I will link to the newsletter so you can subscribe if you haven't. And again, shoot an email to me. Just hit reply when you get the next newsletter and let me know what questions you'd like me to cover in the next show or future show. I'd be happy to take a look at it. So if you have any questions, leave them in the comments below. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.